Index funds versus mutual funds versus ETFs. Which is the best and what's the difference? So let's set the scene. You've just opened your investment account and you're looking for a safer investment option with a hands-off approach to investing. You want to put a fixed amount of money away each month with a set and forget type approach to investing. You don't want to get bogged down with the day-to-day hassle of trading, you just want to take a backseat and let someone manage your money for you. All you're looking to do is put your money away and get a good return on your investment that you don't have to worry about, and you can end up with a nice lump sum. Now in that case, these are probably going to be the best option for you. And as Warren Buffett said, 95% of people are much better off in a fund than buying individual shares. So unless you think you can beat the odds, this is a much reliable way to invest. You can focus on making more money, you can put it away and let these vehicles do the hard work for you. Now the reason these can be such a better way to invest is diversification. Instead of just investing in one company, your money is split across a range of different companies. Generally, there's a much lower risk in these types of investments. I'll talk a little bit more about that later, why it can be good and a bad thing. So you've heard of index funds, mutual funds and ETFs, but you're wondering what actually is the difference. So today we're going to look at what each of these investment vehicles is, the difference between them and which I think is best, because I bought all three. I'm going to share my experience with you. And if you haven't already, make sure you subscribe because I share all the basics of investing to help you make more money, as well as sharing my journey and everything I'm investing in. It's a completely transparent look into what it takes to build a portfolio. I'll also be doing a video on the top funds, so if there's something you want to see, please smash that like button to let me know that's something you want to see. So let's start with mutual funds. Mutual funds actually date way back to the 1800s. They were created as a way for multiple shareholders to come together and invest. Money is pooled together to buy a range of investments, including high-end portfolios that you might not be able to buy on your own. There are several different categories of mutual fund, depending on what proportion of risk to return you're looking for. They allow you to invest in a variety of assets, rather than putting everything into a single investment. Mutual funds are managed by a fund manager who decides where and when to invest your money. So you have the added benefit of a professional looking after your money. And that's essentially what you're paying for by paying that fee. For them, obviously the more money they manage, the more money they make. And obviously the more money you make, the more money they make. But it's in their interest that the fund does well. So you can choose portfolios with different levels of risk. You could go for a low risk portfolio, but generally some of the higher risk can come with higher rewards. And you'll find that your fund manager will be specialised in a certain area. So for example, if you were to invest in a Chinese tech fund, the fund manager is likely going to know Chinese tech inside and out. He's going to know when to buy and sell a company and who to add to the portfolio that can add more value. So they will buy and sell shares in companies based on what they think is going to perform best. And likewise, if they think a company is not going to do well, they can soon drop it from the portfolio, which an everyday investor isn't going to have that knowledge to make those decisions. I certainly wouldn't, and it's very hard for any trader to stay on top of multiple assets. It can be much more reliable to have someone managing it that specialises in a certain sector. Now, there are different types of mutual funds. The most common type of mutual fund are bonds, stocks, money market funds and balance funds. Don't worry too much about them today because it's just going to get way too complicated for you. You just need to think of mutual funds as something you're paying money into, that's being managed, and they're investing in a diverse range of options for you. So you're basically paying someone to manage your money. So how do investors get a return from mutual funds? Now your potential returns will depend on the type of fund you're invested in. There's three main ways to see a return on your investment. If you have a fund with securities that gain value, this is distributed as capital among the shareholders. The second is shares. You can sell some or all of your shares for a profit if the mutual fund's value is increased. The third is dividends and interest. Any money gained in a given year can be paid out as interest on bonds or dividends or stocks. You can either take this as capital or reinvest in more shares. But the most common for you guys is either going to be dividends when the companies make a dividend, so you're going to get regular payments, and certain funds will have different dividends, or you're going to sell your fund and take the profit when you sell it. Now this is where it gets interesting. You have two types of option when you go for a fund. You can either go for accumulation or you can go for income. Now if you go for accumulation, any payments that are paid out from the fund are going to be automatically reinvested into the device. If you go for income, any money is going to be paid out to you directly into your account. I've noticed there is some confusion with people saying that certain devices don't allow you to do these things, but just to make it clear, both mutual funds, index funds and ETFs all allow you to do either. Whether you go for accumulation or you go for income depends on what's most tax efficient for you and what your overall investment strategy is. For me, I'm laser focused on accumulation because at the moment, all I'm focused on is building the biggest portfolio I can. Now when I come to retire, I'll probably swap that over to income because I'm going to be looking at having my lump sum and having money paid out to me to support my living costs and what I want to do. Now let's talk about the advantages of a mutual fund. So the first advantage is you are getting that diversification. So you are able to invest in a range of different companies and you're lowering your risk. And it is regarded as quite a liquid investment. Now when you sell your fund, it's usually up to 7 days, but you can sell it sooner. Now you might think 7 days is actually a really long time compared to a normal share, but actually it really is. But compared to something like property, it's actually still a really liquid investment. You can sell your fund and be done within a few days, which can have pros and cons. It can be a really good thing because actually it encourages you to hold your investments longer. And as we know, people who hold money longer generally make more money. It gets rid of some of that temptation to jump on the latest share that's going to boom and rocket, which can be a really good thing. The third benefit is you are getting that professional management. So you're either getting an individual or group of people managing your money, who are most likely going to have much more knowledge and expertise that you do in the particular area. So they're looking after the money for you. But of course, you are putting an awful lot of trust in them. The fourth benefit is you are getting the ability to invest in larger investments that you might not be able to otherwise. For example, some individual investors might find it hard to invest in foreign markets. And fifth, which is my favourite, is there is government oversight. So any mutual fund has to be regulated by the government, so they have to be really transparent on things like their fees and their gains and losses. It's clear to see what they're making, what they're losing, how much money they're managing, and the size of the fund. Now let's talk about the disadvantages, which are really important. So mutual funds in general are regarded as being more expensive than something like an ETF, which is generally true because they generally take more management, or they might have more people involved that are looking after the money. There's going to be more buying, selling, watching companies, what to buy, what to sell, etc. But of course, it does differ between mutual funds, ETFs, and index funds. The fees are individual to each fund, but of course, it all depends on what your return is. So for example, it's fine paying a higher fee as long as you get a higher return. The problem comes when the fees are higher and you're not getting that level of return to justify it. That's a point where it can be not such a good investment. Another disadvantage, you can't always see the accurate price. By that, what I mean is you can't always see the day-to-day value. It can actually be 24 hours behind the market. So if the market's up, you think it's great, you want to go check your fund, and you can't actually see it in the price. You're probably going to see it the next day, which again isn't a bad thing if you plan to leave it, but if you want to see your money day-to-day, then maybe it's not the right choice for you. But either way, it shouldn't really matter to a long-term investor. The other disadvantage is there's no ability to customize. So for example, you can't just say, oh, I'd like to add Apple, or I want to add Tesla, or I'd like to add Facebook. You just can't do it. You've got to stick to what's within the fund. That's not to say you can't buy funds that have them companies within them, but there's no ability to pick and choose yourself. You've got to go with the fund and what the manager wants to buy. Now the reason I think there's a lot of confusion between these different devices is because actually a lot of people call index funds and ETFs mutual funds. But actually, I think of them as separate devices. For me, I class a mutual fund as something you invest in, people manage the money and look after it for you. They buy and sell shares on your behalf. So that's what I would say is a solid difference. To make it easier, I'm going to show you a mutual fund as an example. Now this is one of the most popular funds, and this is a Bailey Guildford Pacific fund. This is Class B and it's an accumulation fund. So that means your money's getting reinvested into more shares. If we scroll down, you can see the initial charges, 0%, it's free, 0. But there is this ongoing charge of the 0.71%, so that's the fee that you're going to pay. And if you look to the right, you can see the annual return of the fund year to year. So you're looking at 35, 22, 1%, minus 4%, and then 92%. And this is where it gets interesting. So if you would have picked this fund last year, you would have paid more fees that you wouldn't have paid maybe with an ETF, but actually you've made 92%. Now in the same period, if you would have bought something like the FTSE 100, you would have made 18%. So between 18% and 92%, there's a massive difference in your returns. But of course, that isn't to say you're going to get the 92% every year. But for example, if you scroll down even further on the website, this is where it gets interesting. So you can see the top 10 holdings within the fund. So you see which of the top companies they're buying and what the percent split is. You can also look at the top sectors. So this is where it splits it up between different industries. So actually, by buying this one fund, you get exposure to all these different industries and you can see what they're weighted towards. So this one is mostly in software and tech, but actually it does cover some other things like life insurance, precious metals, pharma and non-renewable energy. So actually you're getting quite a wide range of exposure. And this specific fund invests in Asia Pacific, excluding Japan. And you can see that they've got 99 holdings and the size of the fund. You can also look on the top countries and you can see the top 10 countries they're split between. So you can see you're actually getting quite a lot of diversity from this one fund. You're not invested in one particular company or one particular country. So it does give you more of a wide range of exposure. Now the most important question is, would I recommend you buy funds? Now I've had funds in the past, and to be honest, my funds didn't outperform the market, which is crazy because I've just shown you that 92% versus the 18%, and you're thinking, well, that's a massive outperformance. But that isn't the same with every fund. So the way I actually did it, I saw the average was 7% and I picked 3 funds that were all above 30%. And I thought, well, even if they do half the performance, I'm still going to outperform the market. But actually, I was way wrong. In the particular year, my shares did about 15% gain when the market did about 33%. So actually, I ended up way worse off by going with a fund than I would buying an ETF that tracked the performance of the market. So really, it depends if you're looking for a hands-off investment and you're willing to let somebody else look after the money for you. But for me, I'd rather have much more control over what I'm doing with my money. So this is where index funds come in. Now, the differences between an index fund and an ETF are very slight. We're going to talk about them in a minute. But let's talk about what is an index fund compared to a mutual fund. Now, before you say it, there will be some specific examples that are exempt from this generalization. But in general, an index fund is something that tracks the index of a market. So for example, you have the S&P 500 in America, which is the top companies in America, or the FTSE 100 or the FTSE 250 over here, which tracks the top 100 or 250 companies in the UK. Now, buying into an index fund, you're basically getting an average of all of those companies. So you're getting an average of how the market performs. So this is where you can get your general 7% a year set and forget approach. You can get an index for pretty much every country you want to invest in. ETFs, on the other hand, include things like indexes, but they can also include things like general markets. So you can buy things like a mining ETF, you can buy things like a renewable energy ETF, and you can buy things like that. So the way to look at it is you're kind of getting an average of that market. Again, you're going to get that kind of manager, but you're going to get a much more generalization of the market, rather than a fund manager buying and selling companies based on their insights. So it's really more of a generalization rather than specific buying and selling. So let's take a quick glance at the difference between an index fund and a mutual fund. So first, the investment objective. So with an index fund, you're looking to match the investment returns of a benchmark stock market index, e.g. the S&P 500. With the mutual fund, your goal is to beat the investment returns of a related index. So the goal here is to beat the S&P 500, where the index is trying to match it. Both of them invest in stocks, bonds and other securities. So the management style of the index fund is passive, so the investments are automated to match the holdings of the benchmark index. So for example, if a company comes out with the S&P 500, the top 500 companies in America, the fund is going to be adjusted to match it. The mutual fund, on the other hand, is much more active. You've got the stock pickers, which are the fund managers, choosing the holdings. So they're choosing what to buy and sell based on what they think is going to do best. So the average management fee. So of an index fund, we're talking 0.09%, and a mutual fund is higher at 0.82%. Now that might not seem much of a difference, but it does add up. So let's look at the after fee return of investing $1,000 annually, earning 7% over 30 years. So with the index fund, you would end up with $99,000. With the mutual fund, you end up with $86,000. So the amount lost in fees over 30 years with an index fund would be $1,800. With a mutual fund, it's going to be $15,000. So that's where you see the massive difference in fees. Of course, it vastly depends on which one you go for. You could end up with an index fund with massive fees, or you could end up with a mutual fund with really low fees. So you really need to be careful. Take a look at which one you're buying and all the costs involved. So taking a look at this, it's clear that ETFs or index funds would be the winner, unless you're willing to gamble that the company can beat the index and give you much higher returns. But in most cases, it doesn't normally work out. So the biggest difference between ETFs and index funds is that ETFs can be traded throughout the day, and index funds can only be bought or sold at the end of the day. For long-term investments, that's really not a problem, but if you wanted to trade day to day, an ETF is going to be better for you. The other difference, in many cases, an ETF is going to be much cheaper to buy. For example, a company like Vanguard has a minimum investment of $3,000 to invest in one of its index funds. And you can buy an ETF on something like Free Trade or Trading 212 for much lower costs. You don't have to invest anywhere near the same amount. ETFs are also generally more tax efficient, but that also depends on what country you're from. So now you understand the basics of what each of these is, let's sum it all up and do a quick recap. Mutual funds are where somebody manages your money for you. You give them your money, they pick and choose what to buy. Index funds are adjusted to match the index of a particular market, such as the FTSE 100 or the S&P 500. They're aimed at giving you an average return of that market. ETFs, on the other hand, aim to do a similar thing as index funds, but you can also do much more with them. You can buy things like mining companies, renewable energy companies, depending on what you want to focus on. They have a much lower barrier to entry, you can invest in ETFs with a much lower amount, and they're really easy to buy and sell. And just remember guys, while being diverse is great, it's not always the best thing to do. You can actually get much better performance by buying individual shares. But if you are looking for that hands-off approach, I would definitely recommend going for an ETF. Having all three in the past, an ETF is so easy to buy and sell, it's really low cost and you really can't go wrong. But it is important that you buy the right ETFs. What I'm going to do in upcoming videos is break down the top ETFs and which ones I think you should invest in. So make sure you subscribe and stick around for that. My goal is to help you guys make more money on a regular basis and be as reliable as possible. So I hope that's cleared some things up. Thank you so much for watching and I'll see you guys in the next video.